More has to be done. Countries that have surplus doses, we have to share some of those doses.
We are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
We're not seeking conflict with Russia. We want a stable, predictable relationship.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 10th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. President Biden arrives in the UK for the G7 Leaders Summit as the world's richest countries vow to deliver 1 billion extra vaccine doses over the next year. The ECB is set to review the pace of its pandemic bond buying program. Treasuries climb ahead of a crucial US CPI print this afternoon. And meme stock mania gets a second lease of life as the SEC plans to review stock trading rules, while GameStop reveals a new leadership composed of Amazon veterans. So, our top story, let's get straight to it. The G7 Leaders Summit in the UK this weekend starts with some positive momentum after finance ministers reach an agreement on a landmark deal to overhaul global tax rules. As a group comes together face-to-face for the first time since 2019, many important issues remain on the table. Anne-Marie Hordern has a preview.
U.S. relations with traditional allies frayed under Donald Trump. President Joe Biden has vowed to repair this. One area where the group should find common ground, it stands towards China. The world's largest democracies are increasingly determined to combat China's rising influence, be it in so-called vaccine diplomacy or the pace of reducing its reliance on coal. Along with discussing pandemic response and vaccine distribution, leaders will consider climate change, with every G7 nation expressing support of green goals. This meeting offers a chance to craft a strong common message, but the debate over details could expose divisions. President Biden, Italy's new Prime Minister Mario Draghi, and Prime Minister Yoshihide Suga of Japan will be attending their first G7 summit as leaders, while be Angela Merkel's swan song. She's leaving office after 16 years as Germany's chancellor. Her departure will surely alter the dynamic at global gatherings of democratic nations such as this.
Well, in the southwestern coast of England, in Cornwall, for us is Bloomberg's European close anchor, Guy Johnson. Guy, I hope you're enjoying the warm weather, which is quite a rarity in the UK. But we've seen this draft communique from the G7 already. What are the details?
Well, two things to say. First of all, unfortunately, the weather is not that clement down here. We were hoping for sunshine. That is not the case. It has just stopped raining, which I guess is a positive. We have seen the communique. The focus of the communique, Francine, is on what is happening with the vaccine narrative. And what we're seeing here is that there is an expectation that the G7 leaders will commit to vaccinate 80% of the world's population by the end of next year. Now, this fulfills a number of different objectives. First of all, it obviously gives the G7 a humanitarian aspect, which I think most of the leaders will welcome. It also brings together potentially and deals with some of the differences over vaccine distribution that have divided Europe and the United States. But it also has a number of different other positive aspects, Francine. The first one is that it provides an opportunity to fill a gap that China could potentially fill. So the G7 will commit to do this, therefore denying China the opportunity to step in and provide that sort of diplomatic push on vaccines. The next kind of important aspect to this is what is happening with climate. Many poorer countries are saying, why should we fulfill your climate pledges if you are not providing us with vaccines? Boris Johnson's COP conference coming up in Glasgow later this year on climate, hugely important to him. He wants to make sure that these countries don't have that reason to say, we can't deal with the climate narrative because you haven't given us the vaccines. He wants to commit to those vaccines so they commit to the climate narrative. Francine?
Guy, how much, limelight will the Brexit issue and the fact that actually, the UK and the EU are once again almost on the brink of very, fraught relationships, and will the US intervene in that?
Well, So, OK, let's. There were talks yesterday in London between Lord Frost and Maria Sefcovic. They didn't go anywhere. They didn't break down, but they didn't provide progress. And that obviously is a cause for embarrassment to a certain degree for the UK coming into this. Nevertheless, the UK, I think, probably is unlikely to see significant criticism from the US. I think the British papers this morning are making much of this. Certainly the narrative we're getting from the US side is that actually the US is unlikely, Joe Biden is unlikely to criticise Boris Johnson on Brexit. He will, at a very elevated level, suggest that he is very keen to make sure that the Good Friday Agreement is upheld, and he will lean heavily on his Irish roots. But he is unlikely to step in and rebuke the UK. He is unlikely to step in and really get into the granularity of what is happening here with this Northern Ireland Protocol, Francine.
Oh, that's really interesting. Guy, thanks so much. That was the European close anchor, of course, our Guy Johnson, covering the G7 for us over the next couple of days. In the meantime, we're also getting some CPI figures here, well, in the US a little bit later on. Here it's the ECB, so let's quickly get onto your market check. We continue looking at the rally in Treasuries that we saw. For the moment, futures are actually pretty much steady. I'm also looking at Asian stocks. They rose a little bit because of this US-China talks, helping sentiment and bolstered the offshore yuan. Then Treasuries are rallying again. That's ahead of this US inflation report that may provide clues on the monetary policy outlook. And then separately, President Biden did revoke this Trump-era bans on TikTok and WeChat. So that may have a little bit to do also with Asian sentiment. Joining us to talk about the G7 and the markets is Stephen Major, HSBC Global Head of Fixed Income Research. Stephen, thank you so much for joining us. Always a pleasure. There's a lot to talk about, actually, when it comes to Treasuries and the rally that we saw. How are you viewing, first of all, we'll get to CPI in a second, but how are you viewing the G7? Is it communiques that don't actually move the markets, or could we see something substantial?
Well, I suppose some of the news that might matter has already come out, and that was on tax, wasn't it? And markets will interpret that, particularly bond markets, and they'll try and do the calculations on what it means for fiscal policy. So that's something. There's a lot more that we don't know, and of course, everyone's going to be watching in case there's some kind of political announcement that disrupts markets. But don't hold your breath. These meetings don't tend to cause much trouble.
Stephen, first of all, when you talk about tax, I mean, does it actually change your view on anything in the markets? Because it seems that, a couple of countries are now asking for exemptions, and it could take also, years for anything to be concrete. Yeah,
I mean, that's fair enough, Francine. And whatever revenues come in are just filling a hole. So there's been a lot of money spent and committed already. But to me, it's part of a bigger picture. When it comes to the US, there's going to be a deficit ceiling debate coming up. And it's difficult to see how we can have the same kind of fiscal largesse, again, the same kind of fiscal impulse. So to me, it's a reminder that there is the threat of higher taxes in all kinds of different forms. This is at the margin, admittedly, but it's a sign of things to come.
So, Stephen, in terms of things that matter, inflation matters. If we have an uptick in inflation, how much of it is already priced in?
Yeah, well, in terms of what matters to bonds, I think that it's the Fed effect on yields that matters. And the Fed is saying they have an average inflation target. And it seems that the market might be listening, which to me means when you get a 4 or 5% handle on the CPI, it's largely expected and factored in. We've spent much of the last 6 to 9 months preparing for this moment. So markets move ahead of the data. And I think that people are slowly coming round to the idea that the Fed might be right. And that's despite the stampede of people who are coming on your show and elsewhere talking up inflation.
We also heard from the Chinese central bank governor, I think today or late last night, actually saying that everything should be within their forecast in terms of inflation. Is there a chance that we're actually going to be importing inflation from China?
Well, the two numbers that came out of China, one had a 9 handle, that's 9%, that's PPI, and the CPI had a 1 handle. I think the core number was even less. So there's no transfer of the producer price pressure onto the consumer level. So at the moment, I don't think we should worry about that. And it's a question of whether the cost increases can be passed on. And so far, China's giving a great example of how that's not happening.
Stephen, thank you so much. Stephen Major there of HSBC stays with us. We'll talk a lot more about inflation. Now, Jean-Claude Trichet tells his program that he doesn't see an inflation danger in Europe, but in the US, he says it's different. So up next, we'll go back to the conversation with Stephen Major, and we discuss what the upcoming meeting of the ECB means for forecasts. This is Bloomberg.
In terms of anchoring solidly medium and long-term inflation expectations around 2%, and we will see exactly what will be the conclusion of the policy review that is ongoing. But it seems to me that we are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
There you go, Mr. Trichet, saying inflation is not a dangerous level in Europe, but in the U.S. it's different. That was the former ECB president speaking exclusively to this program yesterday. Now, Stephen Major of HSBC is still with us. And Stephen, this kind of goes back to the point you were making before, that many people actually think that inflation is going to be dangerous, that it could surprise, and I guess, take maybe the Fed on the back foot, but you think that's just not true, and it's kind of within the range that you're expecting. Is there a danger that actually the market is pricing things that don't happen? So what is the market getting wrong right now?
Yeah, well, actually, listening to Mr. Trichet there, he was the one, I think, who's first coined the transitory language, and that's a long time ago. So now we're finding new ways of saying the same thing because it's getting a bit boring. I think the Fed's looking at other things like employment, and I think that the market looks beyond the near-term releases like inflation, and is looking at longer-term drivers that matter to bond yields. And some of these cannot be controlled or affected at all by what the central banks are doing. And I'm thinking about debt levels and demographics and technology, etc. So I think that there's a lot of people getting very excited about inflation, and this has been going on all year and through much of last. And we're seeing bond yields falling the last few months, and it's probably very frustrating for those who are looking for higher yields. But to me, the market is just priced logically to what the Fed is saying, that they're not going to hike rates for many years.
Steve, so where do you find value in bonds right now?
Well, for the government bonds, the best on the Treasury curve, we think, is going to the longer end. I'm talking here about 30-year bonds. If absolutely nothing happens and the market just sits in a range, then you need to be more in the sort of 5 to 7 year part of the curve. But the 30 years is where we really like value. But I think in a global portfolio, you have to diversify. So we need to get the right proportion of all the different markets. So, China's done really well this year, and China has outperformed the US by about 10% in dollar terms. I doubt that can be maintained for the second half of the year. But again, it shows the strength of diversification. In Europe, yields have backed up quite a lot, haven't they? And if you think about it, yields for bonds, OATs, and BTPs are in the middle of the range for the last few months. And so they haven't really followed the Treasuries back down to the bottom of the range. So the European markets have potential to rally more, but then it all depends on the ECB.
Yeah, what are you expecting from the ECB today? It's going to be, I guess, difficult for, Christine Lagarde to strike the right tone.
Yeah, well, they're in the process of a deep think as well, don't forget. So they're having a good think about everything that they're doing. I don't think any of us are expecting a surprise. So I think they continue this as long as they can. that I know that inflation's gone up, and that's probably quite welcome from a Eurozone perspective. It's gone up towards the target. But this is not the right time to be withdrawing the stimulus, and it's very early days in terms of recovery. And I think the ECB is going to signal that, even if they do upgrade their growth forecast for the coming years.
But how should they, I mean, should they actually give a more explicit indication of what they'll do with PEP going forward, or is it wrong to have targets?
Well, there's all sorts of things, because we could be creative and speculative about this all at the same time, but there's so many programs and acronyms. And there has been mention of old programs and how these could all be wrapped into the new ones. So with some clever management and creativity, they could create a lot more firepower and buy a lot more time. And that's what it's about. And as you know, there are rules, there are constraints, but the ECB has shown itself to be quite clever with this. And I think it can be stretched out well into the future.
Steve, when you look at forward yields and consensus forecast, and this is something that came out in your note, it's very clear that they're considerably higher than your longer bond yield forecasts. So when are you expecting the market to readjust?
Well, this is interesting because with the Treasury market, there's a lot of juice in the forwards. What I mean by that is the market is priced for yields on the 10-year part of the curve to be about 60 basis points higher in 2 years' time. Now, that seems to be pretty much lined up to where the consensus forecasts are. So people are forecasting what the forwards are already implying. If nothing happens, that's a lot of carry and roll and prospective return to take out. So from my perspective, if the yield is the same now at year end, so if at year end it's the same as it is now, then that's a winning trade. But I suspect with people trying to position for higher and higher yields, the opposite will happen. The Fed and other central banks are looking through the noise. And just because inflation has gone up a bit doesn't mean to say they're going to change their policy. And that's what really matters to bonds. There's a huge central bank effect on the bond yields. And as the short rate stays down, the bond yield just can't go up.
What's your take? I think you also mentioned Brazil or other emerging markets. Is there any value that you're seeing, again, in something that maybe we don't talk about day in, day out?
Yeah. Well, look, this is the thing. I think investment managers are having to work hard to get that incremental return. You talk about EM, and the high yielders have been not the place to be recently. So here I'm talking about countries like India, for example, and you're right to mention Brazil. It has been one of those, but maybe things are changing a little bit. And on the fiscal side, I think we've got a bit more of a bond positive story. So you'll see that our recommendations have been shifting there. Additionally, we like Russia because we think there's been a lot of front loading of the rate hike expectations. In other markets, like in credit, very difficult to get much value when IG credit spreads are so tight, and you have to go down the credit curve. But we're looking in the US around the single B point. It's looking like it offers a bit of relative value versus a high yield. But people have to work for their returns now, and we're in a lower for longer environment, and that means diversify and look for value opportunities.
Stephen, thank you so much. Stephen Major there, HSBC Global Head of Fixed Income Research. Valuable, extremely valuable insight as always. Now, coming up on the program, we'll be live outside the European Central Bank ahead of this today's meeting. Maria today will be watching for any talk about tapering. Plus, the retail-driven targeting of shorted stocks continue with Clover Health and Context Logic gaining again in pre-market. We'll break down the next bout of meme stock mania with Eddie van der Walt. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The US plans to buy 500 million doses of Pfizer's coronavirus vaccine to share internationally. This comes as President Joe Biden is preparing to join other G7 leaders in a campaign to end the pandemic by distributing jabs worldwide. The G7 leaders are gathering for their summit in Cornwall, here in the UK. Meanwhile, President Joe Biden and British Prime Minister Boris Johnson will commit to resuming travel between the two countries as soon as possible. It is not clear how soon that actually will be. The two leaders are meeting ahead of the start of the G7 summit. They will launch a joint task force to explore the different travel options. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, meme stock mania gets a revival. The SEC plans a review of stock trading rules as GameStop announces new leadership. We'll discuss that next with MLive's Eddie van der Veld. We'll also talk, of course, at Treasuries. And don't forget, ECB Day and Inflation Data Day in the US. This is Bloomberg. President Biden arrives in the UK for the G7 Leaders Summit as the world's richest countries vow to deliver a billion extra vaccine doses over the next year. Now, the ECB is set to review the pace of its pandemic bond buying program. Treasuries climb ahead of a crucial US CPI print this afternoon. And meme stock mania gets a second lease of life as the SEC plans to review stock trading rules. GameStop reveals a new leadership composed of Amazon veterans. Well, good morning, everyone. Happy Thursday and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the meme stock craze has been well and truly revived with a host of new names now garnering attention among retail traders, from medical insurance to wrestling to prisons. Reddit's targeting a heavily shorted stocks has been winning formula for those who get in early enough, but targets are dwindling as investors get wise to the gambit. Now, U.S. regulators have also called for a broad-based review of stock trading rules. This call from the SEC Chair Gary Gensler coincided with an earnings report from the original meme stock GameStop. Now, after nearly a 1,500% run-up in the share price this year, the company actually announced new management in the form of two Amazon veterans. Well, joining me now is MLive's Eddie van der Veld. Also, Eddie's in person. I can't believe they let us do this in person in the studio.
We're in the same
This is
studio.
so, yeah, we're going to go rogue and also talk about Bitcoin. But actually, I mean, the meme stocks are crazy because now it's really opening up like a whole new chapter.
Yep.
And so it's kind of like, you know, alive and kicking.
Yeah, absolutely. I think so. I think, look, there was a great discussion by Joel Weber on the podcast Trillions the other day about, you know, looking for an ETF that gives you exposure to these sorts of things. And I think that's the challenge for investors is staying ahead of what is new. It's a constantly moving target. And just knowing what the, where the Redditors are going to turn next, if you were ahead of that trade, you know, it's a killer.
Okay, what I still don't understand is, are they in it for the money or are they also in it for a bit of a laugh? Because if it's for a bit of a laugh, then it's difficult to peg an ETF to it.
Right, it is, but I think there are smart ways that people can go about this, right? So you can track social media activity and say, okay, we're going to take exposure relative to how busy, how many times it's mentioned on Twitter and so on. There are ways of doing this. So I think, down the pipeline, we're going to see these sorts of products. But I do think you're right. The investors, for many of them, it's a bit of a laugh. It's entertainment. But they are doing it to get rich, ultimately, right? It's not just, they're not just throwing money at this. This is not just the new entertainment. It is a way for them to seek exposure and to tap into the zeitgeist.
I mean, we actually also thought about a new coin that we could, for a bit of a laugh, to put in place. But that's another story. So the SEC is now looking at actually these, new possible rules for stocks.
Right.
And this is basically as a reaction to what we're seeing on Reddit and retail traders. How far will they go?
Yeah, I mean, they're constantly playing catch up, right? And this is the problem, is that there are new forms of communication, there are new asset classes out there, and the regulators are always, a step behind, as it were. So I think in the fast-moving environment that we are in today, I just don't see the SEC being on top of things in such a way that they can really tamp this down.
But so what are they trying to do? If you're an SEC regulator, your main concern is that actually what something goes bust and everybody loses money and it's all life savings, or are they looking at it from another angle?
I don't think that is the main concern. I think if you're willing to speculate, you are willing to lose money, right? I think what they're trying to quash is insiders trying to move the market, buying stocks ahead of time, and I think that's classical. But these problems have been with us, as far back, as stock markets have been with us. If you look at, the bucket shops of old, it has always been there that there would be insiders that try and build up liquidity to try and pull in new investors. It's a difficult thing for the SEC to do.
Let's also talk about cryptocurrencies, because I always want to talk to you about cryptocurrencies. Bitcoin regained some ground after slumping below $33,000, but after the high-profile ransomware attack on Colonial Pipeline, which took payment in Bitcoin, the regulatory scrutiny on the asset class is getting more attention than its price swings. Now, the interview for me of the week, without a doubt, was Senator Elizabeth Warren telling our Joe Weisenthal that more needed to be done by Congress.
Banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this. And I think the answer that we saw today is that right now, our regulators and frankly, our Congress is an hour late and a dollar short. And we need to catch up with where these cryptocurrencies are going.
The primary driver behind ransomware attacks isn't the existence of cryptocurrency. There have always been malware attacks. There have always been different types of attacks against organizations that steal intellectual property, that steal client data, that steal financial information, or even steal funds. There have been lots of compromises of financial institutions over the years. I think this really just highlights how important the security and how vulnerable many organizations are. And they really just don't have their house in order when it comes to security.
Okay, so a kind of attack and then the response from the Bitcoin believers. So let's get someone who's right in the middle. Eddie van der Veld is still with us. Eddie, I thought it was pretty extraordinary, actually, because she's right that, first of all, how many people in Congress and amongst regulators understand what we're dealing with?
And I think this is a very different asset class, right? I think tamping down on on investment and speculation in equities is one thing, because this is an asset class that has something underlying that has been there for a long, long time. In cryptocurrencies, I think the regulators have been extremely hands-off because they wanted the space to grow. But ultimately, there has been a lot more wrongdoing in the space over time, and I think this is something that they will probably be a little bit more hands-on. They don't know exactly how they're going to do it yet, but I think there's a growing appetite for saying, okay, well, hang on a second, enough's enough. We've got to bring things under control here.
So, by wrongdoing, you mean the lack of transparency, but then you can also track what Colonial Pipeline and the hack taught us is that actually you can definitely track these transactions. I think it's from the hackers that we've seen. I think, but it's also just coins that have been launched and then bought by insiders, then pumped and dumped. So I think there's been, these kind of schemes we got rid of in equities for a long, long time ago. We said, look, you cannot do that. But now we're seeing this emerging cryptocurrencies, and regulation hasn't caught up with the cryptocurrency space, and there's a lot more to do. And I think the regulators are probably going to focus more on this space than they are going to on equities going forward. Eddie, thank you so much. I'm looking forward to our catch-up also a little bit later. Eddie van der Veld from MLive, of course, looking at everything from these meme stocks or stonks to crypto. Coming up, ECB officials seem unlikely to spring any surprises over stimulus at today's meeting. We're live in Frankfurt next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Bloomberg has learned that United Airlines is in advanced talks to buy at least 100 Boeing 737 MAX jetliners. It would be part of a broader fleet revamp. United sees it as a chance to upgrade at a time when Boeing and Airbus are hungry for deals. Now, Facebook says it will let all employees work remotely even after the pandemic if their jobs can be done from home. But the world's largest social network said it may reduce workers' pay if they move to a less expensive area. Facebook plans to open their US offices to 50% capacity by September. And Keystone Pipeline, a symbol to oil's friend and foes, is now dead. TC Energy has ended its 16-year quest to build the cross-border project that became a litmus test for climate activism and ended up blocked by President Joe Biden. In a statement, the Calgary-based company said it ended the project after consulting with the Canadian government. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, of course, it's ECB decision day, and officials will decide how much monetary stimulus the Eurozone needs as it emerges from lockdowns. From ramping up their bond buying program in the second quarter to keep borrowing costs in check, it's time for officials to settle on a new pace for the months ahead. Now, the central bank is also due to update its economic projections. So let's get more on all of this with our very own Maria Tadeo, who joins us now live from Frankfurt. Maria, can President Lagarde walk the line between an improved outlook while avoiding taper talk?
Yes, Francine, and really that is the question going into this meeting today. We know that on paper, the policy action is not going to change. So this is very much about the language from Christine Lagarde. On paper, as you say, there will be an improved outlook for the European economy. We're probably going to get a revision for both GDP and inflation expectations. Of course, the picture, when you look at the previous projections, they came out in March, and it was a very different situation for the European economy. We're still very much in lockdown. There were still a lot of restrictions, and coronavirus was still rampant in the EU. Now we're looking at an economy that is gaining momentum, especially in the second half of the year. And of course, we have seen that uptick in inflation. There's a big debate as to whether this is just a one-off or something more fundamental. So I have to say, Francine, a lot of the investors and some of the analysts that I've been speaking with this morning, they say the focus and the attention will be on the PEP program and that line on keeping the purchases significantly higher. Some of them have told me if that word significantly does not feature in today's press conference, then you could see a sell-off in some of those European assets precisely because the market right now is not positioned for anything that looks like tapering.
Maria, in terms of the strategic review, so we're also expecting this 3-day retreat from the ECB to reinvigorate the debate. What can we expect?
Yeah, Francine, I would really love to be a fly on the wall there for that 3-day retreat. And this is going back to the strategic review that the ECB had embarked on. A lot of this was suspended in 2020 because of the pandemic, and the focus really changed into just dealing with the economy. But that debate is back on track. And the big focus, of course, is inflation. How to measure inflation, what should be included into measuring that benchmark, but also the number, the figure that you should put into there. And also, Francine, in many of the conversations that you've had with Christine Lagarde, she's also highlighted this idea of climate and how to incorporate that in the European Central Bank's mandate and how that features in the economy going forward.
Maria, thank you so much. Great work out there. Maria Tadeo there in Frankfurt for us. Now, joining us to talk about the ECB is Silvia Ardagna, Barclays Head of European Economics Research. Silvia, thank you for joining us. It's a big day as we wait to see how President Lagarde actually navigates, maybe better than expected economy whilst not talking about tapering. What are you expecting from her?
Good morning. Thank you for having me here. We expect no change to the policy stance, obviously not to the interest rates, but not even to the asset purchases program. So we have said that we expect the pace of purchases to be maintained at the Q2 average. This still leaves the ECB with some flexibility. We know that they have bought about 80 billion per month in Q2 so far, but obviously June is still to come. So we don't expect much in terms of monetary policy decision. The action will be also on the forecast changes. And here we also believe that there will be a sizable upgrade to the 2022 growth forecast. This in part to reflect the fact that there is a bigger carryover from a strong H2 this year, but also because we think the ECB will upgrade the assumption on fiscal policies. Remember that the ECB has still to incorporate the impact of the US stimulus package that was passed in March, and they estimate it to be worth about 30 basis points over 2 years. But also it is likely that the assumption on euro area fiscal policies are going to be upgraded, both because the stability program countries submitted to the European Commission show that there is more fiscal, but also because the Commission gave upbeat forecast of the NGU funds.
So, Sylvia, overall, what are you hearing, or what should we be hearing from PEP? Is this maybe the only thing that the ECB could actually give us more of a guidance of what they plan to do with it, or are you expecting not much on that front today?
So we don't expect much on guidance beyond Q3, and this is because, as you said just before, the strategy review is about to be completed, and so we expect more action relative to forward guidance in terms of asset purchases in the September meeting. But clearly through the forecast, right, we will have a sense that the outlook is very much improved. We also think the ECB will try to stress that the acceleration of inflation this year is going to be a one-off temporary phenomenon, and so they will look through it for now. But again, when it comes to the pace of purchases for Q4, it is likely that maybe the ECB will reflect later on in time the improved forecast.
Sylvia, what is the Eurozone's biggest challenge at the moment? So if you look at the Fed, I guess it's inflation, but the ECB has another set of problems.
Yeah, I think the main challenge that we see is the fact that the recovery is starting, but it looks like to be a divergent recovery across different areas and different sectors and countries. And it is important to avoid or limit what could be long-term scarring effects from the pandemic. When we look at the labor market, we say there is more slack than meet the eye if you just look at the unemployment rate. Keep in mind that there has been a sizable decline in hours worked and that labor force participation has also dropped. So as economies pick up and as government gradually scale down fiscal policy, some of the workers on furloughs might lose their jobs, and jobs might not be created at the same speed at which new people join the labor force. So there is going to be a period of transition in which we need to be watching for scarring effects and how deep these are going to be.
Sylvia, and the other big story, of course, is what's happening between the UK and the EU. The fact that on this Northern Ireland protocol, things are just not getting better, and it seems that we're also talking about tariffs and potential quotas. How does that play out into your economic forecasts? Is it for the moment, noise or scaremongering, or could it actually have a deep, long-lasting impact?
Yeah, we have not really, focused on this. It's not something, we basically have all the new trade relationship between the UK and the EU backed in, obviously, in our forecast from both sides from both country sides, but nothing of what we are hearing, these days have changed our outlook both for the euro area or the UK.
Sylvia, as always, thank you so much for joining us. Sylvia Ardagna, there, Barclays Head of European Economic Research. Coming up, Credit Suisse loses a trio of senior bankers. Bloomberg learns that the lender is planning retention bonuses to keep senior staff on the payroll. That scoop is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a trio of senior Credit Suisse bankers have left the firm. It's the latest in a string of exits following the lender's recent debacles with Archegos and Greensill. Andrew Conway, Charles Hadid and Marco Staccioli are moving on to Bank of America, Morgan Stanley and Jefferies, respectively. Bloomberg has also learned that Credit Suisse is set to offer retention bonuses to top bankers to stem the flow of senior departures. Well, joining us now for more on this is one of the reporters to break that story, our finance reporter in Zurich. He's Patrick Winters. Patrick, great to have you and great scoop. What is the potential size and scale of these retention bonuses?
Hi there. So it's a difficult one to work out, and while we've had some indications, it's not something which we're ready to publish yet. But you can definitely think about these guys. These are the top revenue generators. Within the investment bank who are leaving, and what Credit Suisse is doing is trying to protect its revenue base. These are senior guys in the US. These are guys with responsibility for transactions. So you can imagine these are people who are earning $500,000 a year minimum. Many of them more than $1 million, and they can take their business elsewhere. So Credit Suisse is eager to give these guys some assurances that they will be taken care of. But what Credit Suisse is doing is also about reputation, because at the moment they're a bit like the kid at school who's being picked on. With the American banks picking away their most senior people, so they have to show that Credit Suisse is a place where people should be proud to work and where they also get paid competitively.
So will it be enough, I guess, to stem, people leaving, or are other banks also doing the same, in increasing bonuses to make sure that they attract top talent?
So one key thing about this point in time is that Credit Suisse is in a very difficult situation. They've had these twin disasters of Greensill and Archegos, which have really torpedoed their profit in the first quarter. It's also seeping into the second quarter. Meanwhile, it's been an amazing start to the year for most investment banks. There's good trading numbers, and at the same time, lots of deal-making activity, lots of IPOs. So this should be a point in time where bankers are being paid the most. This is almost a peak in payment and bonuses for them. So it's not a time where you can afford to not pay them right, because given this kind of cutthroat industry, they'll just take their business elsewhere. So I think Credit Suisse will definitely be giving some kind of assurance whether they're paying large quantities of cash now. Difficult to say.
Who, Patrick, is more in demand? Is it junior bankers, like we saw, for example, at UBS, for these retention bonuses, or is it top bankers?
I think right now what Credit Suisse is trying to do is stop the defections of top bankers. When they look at it over the next 5 or 10 years, though, it's also a point about keeping juniors, but that's not just related to Credit Suisse. I think that's also an industry topic where they want to keep these analysts who are sometimes working 60, 80, or 100-hour weeks interested in working in banking and not moving on to tech industry or somewhere else.
Patrick, thank you so much. As always, Patrick Winters there, our finance reporter in Zurich. Now, let's also look at the markets. A lot of the focus, of course, is on Treasuries and the rally that we saw yesterday. This comes on the back of, a little bit later, we'll have some inflation figures, CPI from the US. It's also ECB day. So before the inflation print and the ECB, things look pretty stable. That could change. It's very clear that if you look at, the US-China talks going a little bit better or in the right direction, it certainly helped with sentiment. And they also bolstered offshore yuan. Plenty more of Bloomberg Surveillance Early Edition is up next with Matt and Kailey. This is Bloomberg.
We are watchful because we have never experienced in the past a recession that was self-inflicted.
It's not like nothing is getting done, but on really big issues out there, like on coronavirus response, like on climate change, we are very, very far from meaningful global coordination.
The United States has a responsibility, a moral responsibility, to help people get out of the pandemic and the vaccines. But there's a leadership in the global economy that frankly starts at home.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London, Berlin, and New York on this Thursday, June the 10th. Our top stories today. Biden's ambitious agenda at his first G7 summit. The president is pushing plans to vaccinate millions around the globe and to reopen travel between the U.S. and the UK. The ECB plots its next move. Central bank officials will decide today just how monetary stimulus the Eurozone needs to return to normal. And new reason to worry. Today's CPI numbers may show whether higher inflation in the U.S. is here to stay. I have to say there are a number of stories, Kailey. I was looking at President Biden's agenda. It does seem packed. They could touch on Northern Ireland or not, but it's very clear that the market will get impetus from ECB and then U.S. inflation data.
Yeah, the G7, Biden's meeting with UK Prime Minister Boris Johnson, plus the ECB, plus CPI. Not a busy day at all, Francine. But here's how we're shaking out in the markets ahead of that. In the Asian session overnight, most stocks were higher. The Hang Seng was essentially flat, but the Kospi and the Nikkei did close in the green. And your outperformance actually came from China, with the CSI 300 up about 0.7%. Of course, that is after news overnight that the U.S. Commerce Secretary and Chinese Commerce Minister held their first call under the Biden administration, pledging to continue to push for trade and investment ties. The Chinese yuan was stronger against the dollar substantially after that news. It has given back some of those gains, though right now we're sitting at 638 or so. Of course, it is mostly a stronger Asia-Pacific currencies against the U.S. dollar today, including the Japanese yen, which is sitting around 109.48. Here in the U.S., of course, we are awaiting that inflation data at 8:30 a.m. Eastern time. And ahead of that, we're sitting just shy of record highs. S&P 500 futures right now up less than 2 points. We're sitting right around that 42.10 level. In the bond market, of course, we did see that rally yesterday. A lot of that may have been due to short positions unwinding. And this morning, we are holding below that 1.5% level on the 10-year Treasury. Does not look like a market that is concerned about inflation. Elsewhere, I would point that oil is just below $70 a barrel on WTI, and we are seeing a continued tick up for Bitcoin, though it is off session highs right now, essentially flat, right around that $36,000 level, Matt.
All right, we'll be watching that closely, but it does seem to be holding relatively steady around this level. The drop that we saw earlier in the week notwithstanding. Let's take a look at what's going on in European markets right now. We have equity indexes that are down across the continent, or down very little. That's the gray that you see on the map there. With the exception of the UK, it's a gainer. The FTSE up ahead of most other indexes. Take a look at the Stock 600, the broader European benchmark index, and you'll see it is... Well, do I not have the Stock 600? No, I've just got the FTSE here, interestingly enough. But the FTSE is up, the Stock 600 is down. That was going to be my point. The 10-year German Bund right now at 24 basis points to the negative. We'll be watching that very closely as the ECB comes out a little bit later. And, of course, you can see the euro right now trading at 121.66. So hovering around its recent highs, not quite up to the 5-year high at 125, which may make the ECB a little bit more nervous. And I put the pound in there. You know, there was a report, Francine, in a British newspaper earlier that said the U.S. was going to issue a diplomatic rebuke of the UK's behavior around Northern Ireland. Now we're hearing from an official that there will not be a diplomatic rebuke. They're still unhappy about the way Boris Johnson is handling Northern Ireland, but they're not going to officially chide him, according to this official.
Yeah, I have to say that would have been, frankly, pretty punchy. And at the same time, once it's leaked, it's almost like you're rebuked, even if it's not official. Now, let's look at what else is coming up today at 7:45 a.m. New York time. We'll get the latest ECB rate decision, followed by a press conference from President Christine Lagarde. Then also at 8:30 a.m. U.S. time, we'll get U.S. May CPI and jobless claims. Iran nuclear talks reconvene today in Vienna. And finally, the U.S. President Biden with the U.K. Prime Minister Boris Johnson will hold this bilateral meeting today ahead of the G7. As Matt was saying, we're no longer expecting a rebuke over Northern Ireland or the Irish Protocol, but they will be discussing ending the bitter standoff over, of course, actually they'll be discussing resuming travel between the U.S. and the UK. Now, our Guy Johnson enjoying the Cornish weather over in Cornwall, where the G7 is meeting. Guy, what exactly will they talk about? So we're not expecting an official rebuke, but a lot of the talk will be, of course, on COVID vaccinations.
Yeah, I think that's going to be one of the big themes that comes out of this meeting is, and we've seen this in the communique, which has already been leaked, we are going to see a plan basically to try and vaccinate the world. This fulfills a number of different objectives. It basically gives the G7 a humanitarian role. It allows the G7 also to push forward with its agenda rather than letting China step into that void and help vaccinate the world. It also deals with the issue of many poorer countries saying, well, if you can't help us vaccinate, why should we sign up to your climate pledges? And Boris Johnson's very keen for those climate pledges to be delivered, particularly ahead of the COP summit coming up in Glasgow later on this year. Brexit will come up, Francine, but as you say, it looks like we won't get that official rebuke. It looks like maybe the British media has overbid that story, and it doesn't look as if that's going to happen. It will be surprising. Joe Biden is coming here to make friends, to put the Trump era behind the United States and its relationships with its closest allies. He's trying to build a coalition of democracies to push back against autocracies. China, Russia will be a key feature, therefore, of the landscape as well. Just how hard the G7 is going to be prepared to push back, I think quite hard on Russia. It'll be interesting to see whether China gets mentioned. China will be a big theme, though.
Yeah, and of course, Guy, we got news overnight that the U.S. Commerce Secretary and Chinese Commerce Minister have talked. They're pledging to push forward with trade and investment ties. If the U.S. is trying to rebuild its relationship with China that way, how can the G7 come along with them in that effort?
Well, I think this is a really interesting paradox that we currently face at the moment, Kailey. At one level, clearly, the US wants to push back against China. It wants to push back against autocracies. It wants this club of democracies. But when it comes to trade, when it comes particularly as well to climate, how do you marry these two things together? And I think that's going to be the real challenge here at the moment. How do, for instance, on climate, so you say on one hand, look, we're not happy with what you're doing. We're not happy the way we're dealing with Hong Kong, the way you're dealing with the Uyghurs. We're not happy with all of that, yet at the same time, we want you on board with our climate pledge. I think the idea is you have this kind of overwhelming global force when it comes to signing up for climate pledges that China simply cannot ignore.
Guy Johnson, thanks very much, reporting live from Cornwall. Let's turn now to the ECB. We'll get a policy decision, economic forecast, and a press conference from President Lagarde later today. In focus, the scale and pace of the bond buying program. Joining us from Frankfurt is Bloomberg's Maria Tadeo. So, Maria, can Lagarde walk the line between an improved outlook and avoiding taper talk?
Well, Matt, really, that is the core of today's meeting. We know that on the policy front, not a lot is going to change, but that press conference will be interesting, especially because we're going to get new economic projections that will paint a more optimistic picture of the European economy. We're likely to get a revision to both GDP and inflation. The dynamics in the European economy have really changed from March when the first initial forecast was put out. This was the height of the pandemic. This was a lot of restrictions and Europe closing. Now we're looking at an economy that is gaining momentum. Now, the market is not positioned for anything that looks like tapering. Christine Lagarde herself has said that any discussion about tapering is now premature. But as you mentioned, there will be a very strong focus on the language around the PEP program. In particular, this one line that says significantly higher pace of purchases in the PEP program. You know, a lot of the sources and people I've been speaking with this morning, they do say that if that language gets changed, that word significantly is not featured there, you're going to be very much going to be getting a sell-off after the meeting. So again, it's a very tricky communications task that Christine Lagarde has today.
Maria, what are we expecting in the strategic review?
Yes, and Francine, you know, a lot of the ECB watchers actually tell you that this is the thing that really matters. To some extent, it is a battle for the soul of the future European Central Bank. A lot of the debate focuses, as you can imagine, on inflation. You know, that target close but below 2%, but also the way that you measure inflation. You know, I hear many economists who now say housing costs, for example, that should be included in it and it should be measured differently. There's also a new element coming into play. You know, in all of your interviews with Christine Lagarde, she always highlights this idea of climate and climate risk and how this needs to be incorporated. So it'll be interesting to see how that debate is injected into new life now that the worst of the pandemic does seem to be over in Europe.
All right, Bloomberg's Maria today are reporting from Frankfurt with just about 2 hours and 35 minutes or so to go until that ECB decision. Now, I do want to take a quick check on some stocks moving in pre-market trading here in the U.S., one of them being GameStop. It, of course, reported results after the bell yesterday, did tap two Amazon veterans to be CEO and CFO, but the company also announced a share sale of as much as 5 million shares and said the SEC is investigating trading of its stock. That investors don't like so much. The stock down about 8% in early hours. And of course, GameStop is the OG for the meme stocks, but there's a new batch of them that are now at the forefront, one of them being Context Logic. The shares did fall yesterday. This morning, though, they're up about 4%. One stock that rose substantially yesterday in this new wave of meme equities was Geo, the private prison operator. Shares were up 38% in yesterday's session. Today, though, they're down about 8.5%. So it's a bit of a mixed picture when it comes to those meme stocks this morning, Francine.
Yeah, I know we'll talk a lot more about these meme stocks throughout the day. Coming up, Seema Shah, Principal Global Investor Chief Strategist. So we have a lot to talk to her about: inflation, ECB, and maybe we'll touch on some of the retail traders and the possible new rules on U.S. stocks. And then later this hour, Randall Kroszner, a professor at the University of Chicago Booth School and former Fed governor. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, in our Taking Stock column today, we focus on capex. Spending is back with the reopening trade. It looks like companies are now choosing to invest or expand more often than they're choosing to give money back to shareholders in the form of dividend. I've got a great chart that you can see. I stole it from Michael Msika, who wrote this Taking Stock column today. And for our listeners on radio, we welcome you as we do every day. I'll just point out that what this shows is the Barclays Europe capex beneficiaries, that's the white line up here, is outperforming the S&P 350 Dividend Aristocrats Index. So if you invested in companies that benefit from capex, you're doing better than if you're relying solely on dividend plays. Joining us to talk a little about this and much more is Seema Shah, Principal Global Investors Chief Strategist. Seema, what this says to me is that the reopening play is alive not only for investors, but also for executives.
Yeah, and I think we've been seeing evidence of that across most of European activity. And this is a really big change from where we were 3 months ago. So many concerns back then, but really the tide has kind of shifted for Europe. It's really promising to see that capex is moving forward. A lot of people have concerns about, what happens post that reopening bounce. This is a promising view to kind of post those next 3 months as well.
What is the one thing, Seema, when you look at all the inflation expectations, if we have a big print on inflation today, is it already priced into the markets?
I think to some extent the market has moved on from thinking about the level, right? They know that there's a fair risk that things are going to be higher than expected. CPI will be higher than what was anticipated just 3 or 4 months ago. The concern now is just how sticky that inflation is. Now, unfortunately, it's going to be very, very difficult to have an idea of how sticky it will be for several more months. And I think that's one of the reasons why we've actually seen markets be pretty much range-bound over the last couple of weeks. They know that it's still some time to go before they get that very key question answered.
But so, Seema, where do you see the best value? What are you buying right now, given the uncertainty and the fact that we still have to wait a couple of months to exactly know the full picture of what's going on?
Yeah, so I think there's a couple of themes at the moment. So I think on the inflation side, even if, there's a lot of people out there, including ourselves, who believe it will be transitory. But even if you believe it to be transitory, you still have to take note of the inflation risk out there currently. So there needs to be some kind of portfolio protection. We like real estate, particularly data centers. That's kind of playing on the technology, the reopening trade, as well as trying to think about inflation. But increasingly, from a regional perspective, Europe, it's really showing all the right signs for now. The reopening trade is back on. We have European inflation probably lagging behind US inflation, which certainly suggests ECB dovishness lasting longer than the Fed. So there's a couple of things all moving in the right place, in the right direction for Europe as well.
So does that mean you're no longer underweight Europe, Seema? You have been against consensus for some time.
Yes, exactly. So we have moved to an overweight position for Europe. There's a number of reasons. Originally we were quite hesitant about how successful Europe would be with regards to the vaccine campaign. Clearly, they're doing very, very well, and reopening is underway. The momentum is picking up with activity. On inflation, it's kind of lagging behind the US, as I said. And of course, if you believe in the value trade at the moment with the steeper yield curve, Europe is the place to be playing that trade.
Do you think we can break out of this range anytime soon? Obviously, the stock 600 has just been inching record after record, but we're looking at very marginal moves. What makes us move substantially higher, in your view?
Well, as I said, I do think for the next couple of months it's going to be range bound, but also really quite vulnerable to any major disappointments, right? So we have everything on a standstill, waiting to see how the inflation story goes, waiting to see how central banks are going to react. So that communication from the various central banks has got the potential to shift one way or the other. But I think for us, the baseline scenario is that this is going to be your typical summer lull, with of course that vulnerability given given the slower liquidity that you typically get this time of year. Come fall, I think it'll be very different.
We haven't seen a lull for the meme stock, Seema. I got to get your take on this, although I know, it seems to be something maybe trivial, maybe a fad, but it just doesn't stop. Is investing changed?
Look, it is just really, really interesting. It's fascinating for all of us to watch. Does it change the way that we trade and the way that we're looking at the various stocks? No, not really. We're still very much believers in that fundamental analysis. A lot of these meme stocks, we should expect volatility. There's investors looking for quick gains. So, it's probably not something that to be looking at if you're a medium to longer term investor. This is very much day trading, kind of very, very short perspectives, which is certainly not our approach.
All right, Seema, thanks so much. Seema Shah, their Principal Global Investors Chief Strategist. Now, later on, Bloomberg Surveillance, a conversation on the return of travel with the International Airlines Group Chief Executive Officer. He's Luis Gallego Martin. It'll be interesting to get his take on President Biden meeting with the Prime Minister of the UK and whether travel between the UK and the US will be much easier in the future. That interview, 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg. First word news, and the US and China have agreed to push forward trade and investment links. Now that came out of the first call between commerce ministers from the two countries since the start of the Biden administration. It's still not publicly clear what the US plans to do with the Phase 1 trade deal signed last year or tariffs on Chinese goods. Republican Mitt Romney and a handful of other Republican and Democratic senators are coming up with their own infrastructure plan. But they're moving forwards without any of the tax hikes that President Biden has demanded to pay for the spending. Now, Romney says tax increases are a red line for the group, but he would not say how the plan would be funded. And President Biden and British Prime Minister Boris Johnson will commit today to resume travel between the two countries as soon as possible. It's not clear how soon that really will be. The two leaders are meeting ahead of the start of the G7 summit. They'll launch a joint task force to explore travel options. And Brooks Brothers is going casual. The New York-based chain that has been dressing business people for 200 years is coming to grips with the new normal. Now, even before the pandemic, shoppers' tastes were moving away from suits and towards more casual clothes. Brooks Brothers is planning to relaunch after exiting bankruptcy last year. Now, it involves a new athleisure line and a product mix with other casual items. I have to say, our Matt Miller is absolutely up in arms about it. And I had you down as a more casual athleisure wearer, Matt. So you've confused me.
No, it's heartbreaking. I have to tell you something. This tie, I stole this from my dad's closet for my 8th grade graduation from the Columbus Academy. This is what Brooks Brothers quality meant. You know, it's a family tradition. It's an American tradition. And going into yoga pants just doesn't make a lot of sense to me for this brand.
But no one's going to be back in the office in as formal a setting post-pandemic, right? Or at least that's the idea, that we're not all going to need suit and ties, except for maybe Matt Miller because he's on television every day. But, you know, got to move forward.
I mean, booted with Savile Row.
Yeah, that's the idea for sure, Kailey. Yeah. Everyone's working from home. You don't need to wear a suit. But then, you know, hunker down. Stick to your knitting is what I say. Stick to the golden fleece, not Henry the sheep.
Yeah, I mean, tough when you've just come back from bankruptcy. Coming up, Randall Kroszner, professor at the University of Chicago Booth School and former Fed governor. We talk inflation. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Matt, ECB and inflation, that will keep the markets occupied. And then we'll look at the SEC with yesterday, the fact that they're looking at possible new rules for U.S. stocks.
You know, that is actually a huge story among our clients. Yeah. I got a lot of feedback yesterday when those headlines came out from Gensler. I think a lot of brokerages would like to see something changed here. A lot of dealers would like to see something changed. In terms of the ECB, what I think is really interesting, Francine, is, you know, the U.S. clearly wants to overshoot, but the ECB so far has said their inflation target is as close to 2% as they can get, but below it. And it seems incongruous with the Fed message. Maybe that'll change today.
Yeah, and I think there's been, I mean, I've been reading quite a lot of notes from some of the big banks saying, look, the problem for the ECB is not really inflation. They have other, fish to fry, also given the amount of stimulus that they're pumping into the economy. So it'll be interesting, Kailey, to see how all of that is playing out in the markets.
Well, how it's playing out in the markets, Francine, is we're not going a whole lot of anywhere. The market, of course, awaiting that ECB decision at 7:45 a.m. Eastern time, and then that CPI data at 8:30 a.m. Eastern time. So we're looking at very small moves right now. The stock 600 is lower, falling from a record high, but only down about 0.1%. And I went back and checked. The last time we got a move of more than 0.7% on the stock 600 was on May 21st. So this is now the 15th consecutive day of a move smaller than that. Of course, we are looking at going nowhere on S&P 500 futures at the moment. We're up just about 0.25 point. Again, we're all just awaiting that inflation data. The bond market, though, does not seem too worried about inflation. We are steady on the 10-year yield at that sub 1.5% level.
Oh, yeah.
And the dollar unchanged. So again, there's just not a lot going on. Where there's more going on, though, is at some of the individual movers, those meme stocks, and it's a bit of a mixed bag today. You have some Clover Health, Context Logic higher. They're up 6.6, 4.1 or so percent respectively. But two of the others, the OGs, AMC and GameStop, are both lower. Of course, GameStop down now about 7% after its results after the bell last night. What investors didn't like in those numbers are really more about the company's commentary, a share sale, and then the SEC looking into the trading of that stock, Matt.
You know, Kailey, you called it yesterday on the 10-year yield when it was above 150. You said it was headed down. I think you have a future at a macro hedge fund. I would invest
with
you in. Yeah, well, or you're a clairvoyant. I've got a chart that shows what happened yesterday and what's happening now with the 10-year yield. For our listeners on London DAB Digital, I'll walk you through this. It is the 10-year yield, and what you can see is a candle chart here coming down through some key levels. This is the prescient call that Kailey made yesterday, but it's really interesting if you believe inflation is going to tick up up and here to stay. You know, if the Fed has to get more hawkish, why on earth would you be in there buying more bonds? And it looks like, Francine, that's what investors are doing.
Yeah, it's certainly what investors are doing, Matt. And it's one of the stories that will run and will keep us, occupied for weeks and months.
Yeah, well, another thing that's going to keep us occupied is it looks like the meme stock trade, it couldn't be further from following Treasury levels, could it? But GameStop is warning of an SEC probe. Wall Street's top regulator is calling for a broad-based review of stock trading rules, including looking into the trading of the original meme stock. So these are sort of two separate things. One is an announcement from GameStop. The other is an announcement from Gary Gensler. In any case, they both touch this world of meme stocks. Let's get to Bloomberg's MLive editor Eddie Vanderwalt for a little bit of a look into what's happening here. Eddie, it's pretty amazing that this continues to happen. We talked to Seema Shah earlier. She said if you're a midterm to long-term investor, you don't need to deal with this. But day traders definitely can no longer ignore it.
Yeah, and you know what? I mean, it has an impact on the wider market as well, because, I don't think because it plays in on the factors. I mean, some of these are value stocks, and they have done particularly well, and that's helped to change the overall fate of value investing in the last few months. So I think this is it's a really interesting story, and I don't think that even long-term investors can really ignore what's going on in these stocks.
Eddie, what kind of rules could we actually see in place? Like, how much of a game changer is this? Or is this, once again, a regulator just trying to play catch-up?
Yeah, I think that the regulators are playing catch-up. But I think, really, a lot of the rules are already in place. It's just a case that they have to be enforced in a new forum, right? There are restrictions on what you can say if you are an investor, if you have insider information on stocks. So I think there are rules already in place. A lot of it's not being enforced. But at the moment, we are seeing new venues, and it is quicker and it is anonymous. It's very much easier to move stocks without people knowing who you are. And I think for those reasons, the SEC is struggling a little bit.
Eddie, I want to turn to the world of cryptocurrencies now because, of course, Democratic Senator Elizabeth Warren was on Bloomberg television yesterday and told our Joe Weisenthal that the market for digital coins is the Wild West and said that more regulation is needed to protect consumers from scams. Just take a listen to what she said.
Banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this, and I think the answer that we saw today is that right now our regulators and frankly our Congress is an hour late and a dollar short, and we need to catch up with where these cryptocurrencies are going.
So I guess my question, Eddie, is Bitcoin at $36,000 properly pricing in regulatory risk, not just in the U.S., but really globally?
Yeah, I don't think it is. And I mean, that's an absolutely great quote. Hour late and a dollar short. I think that's exactly right. The regulators are really playing catch up. And this is a space where they will have to pay more attention because there is really no regulation. This is the complete opposite of the story we were just talking about in stocks, where the regulation is already in place. This is asset classes. We've seen all of this before. It's just a new forum. This is completely different because it's a different kind of asset class. It is things that we don't know yet. It's it's a whole new venue. So therefore, regulation may have to be a little bit more hands-on and maybe a little bit more hands-on in how they classify these things, because cryptocurrencies is not a unified bunch.
You know what's interesting? Well, first of all, she says Wild West like it's a bad thing. My dream is the Wild West. Eddie, Joe Weisenthal the other day was pointing out, Bitcoin can't be a currency, I should say, cryptocurrency or otherwise, because no one is required to accept it for payment. Now that's changed, right? Now El Salvador says they're going to take it for tax payments. Merchants have to accept it. It's become legal tender in El Salvador. Is this a big deal?
You know what? I mean, it's easy to dismiss it. It's only El Salvador, whatever, right? But it is really important. When I was a couple of years back, when cryptocurrencies were new, a lot of people were skeptics. I was amongst them. And one of the things that I said was, look, we've never seen any country willingly give up its ability to be the only publisher of legal tender in its borders, right? These things don't happen because the authorities say that they will. Now, this is different. This is the first time that we've really seen somebody say, okay, well, we're gonna make this legal tender. So does that mean it's going to be the case in the US? Probably not. But it is a game changer for cryptocurrencies. It shows that there are those who are willing to accept it.
Eddie, thanks so much. Bloomberg, MLive's Eddie van der Walt there on everything from cryptocurrencies to meme stocks. Now, coming up, Randall Kroszner, professor at the University of Chicago Booth School and former Fed governor. We'll talk, of course, about the CPI print. That's coming up a little bit later. This is Bloomberg.
In terms of what matters to bonds, I think that it's the Fed effect on yields that matters. And the Fed is saying they have an average inflation target. And it seems that the market might be listening, which to me means when you get a 4 or 5% handle off the CPI, it's largely expected and factored in. People are slowly coming round to the idea that the Fed might be right. And that's despite the stampede of people who are coming on your show and elsewhere talking up inflation.
Stephen Major, their HSBC Global Head of Fixed Income Research, talking inflation earlier on Bloomberg, probably talking also about Mr. Trichet and others saying that they were worried about inflation, especially taking hold in the U.S. I think they used the word overheating. Well, joining us now is Randall Kroszner. He's a University of Chicago Booth School of Business professor and former Fed governor. Randy, always great to speak to you, especially on such an important day for CPI reading. If you look at the markets, they're not really believing the Fed and how they're guiding them. So who's right?
That is the $7 trillion question because it's the Fed's balance sheet. So the Fed keeps saying that it's transitory, and at least in the short run, it is. You can say last month it was due to high used car prices. I'm sure there'll be some particular factor that could be pointed to for this month and for the next few months. But we're going to see some very high inflation prints. And the real question is not just whether the inflation itself is persistent, but do people believe that it's going to be persistent? Could inflation expectations become unanchored? That's really the challenging question. And that's the one that that's a lot based on sort of behavioral economics, behavioral science, psychology, rather than traditional economic modeling.
But if you look at the economic model, I mean, we had a print of inflation 9% higher in China. Is that under control, or could we be importing it from the Far East?
Well, I think part of that was because you saw a lot of increases in input prices. I mean, we're seeing commodity prices really take off. We're seeing shipping costs take off. And so input prices are going up. Undoubtedly, that will mean higher output prices. But again, the question is this just sort of a transition from an extremely low base from a year ago when things looked super bleak to now adjusting to something looking super strong? So it's a one-time change. That is, it's transitional. Or is it something that's going to be persistent? And that really comes down to expectations of whether wages keep going up, whether other prices keep going up, whether people expect prices to keep going up.
You know, the inflation that we're seeing now is higher than inflation that we've seen in the past decade. But over the past few decades, prices have continued to go higher and wages have stagnated for the American worker. Is that going to change now?
Well, that's, again, it gets to this question of what will wage demands be relative to what employers are willing to give. And certainly all of the stories, whether they're in the US, UK, or continental Europe, is that, and particularly in the US and UK, we're seeing labor shortages, that it's difficult to hire people. And so firms are offering bonuses, offering special schemes, and offering higher wages. So I think we're going to see a significant move up in real wages, as we've already started to see in the US. And again, the question is this a 6-month thing just through the end of the year, or is this something that's going to persist into 22?
The University of Chicago School of Economics has to be the epitome of American economic thought, led by Milton Friedman and George Stigler, and now people like you, Professor Kroszner. How does Chicago economics view the current fiscal activity? What is the new classical macroeconomic view of all of this fiscal stimulus?
Well, certainly I wouldn't want to speak for my colleagues because, as you well know, at University of Chicago, our tradition is everyone has their own view, and so I'll give you my view, which I think we're doing an enormous amount of spending. If you look at what happened a year ago in the response to the pandemic, which I think everyone would agree was a sensible, immediate response, most countries spent somewhere between 10 and 20% of GDP. But then we spent $1 trillion last December, $2 trillion in the rescue package that was already passed. And there's another roughly $4 trillion on the table. That's 50% of GDP in a year and a half. I think it's very difficult to spend that much responsibly. You can only spend it responsibly if it's going to have a good payoff in terms of solving real problems, inequality or climate issues, or having a lot of productivity payoff. And I don't think we can do that so quickly.
And of course, this is an unprecedented amount of spending, Randy, just like we've seen unprecedented monetary policy throughout this pandemic crisis. We talk so much about normalization here on Bloomberg Television, but can we ever actually go back to normal?
Well, I think trying to go back to the past, that's not the normal going forward. So I think going back to normal isn't the right way to think about it, but can we have something that's more sort of stable, normal going forward? And I think eventually we can get there. Now, obviously, we were on a path to getting there before the pandemic hit. U.S. had raised interest rates, in the realm of around 2% or so, even though inflation had not gotten to its 2% target. We had near record low unemployment. So the U.S. was on a good trajectory. Then, of course, the shock hit. Shocks are always going to come. So it's always hard to get to kind of that long run steady state. But I think we would eventually move, not in the next year, but over the next few years, to interest rates closer to where we were before the pandemic, and hopefully unemployment rates that are around that same level.
Speaking of things that are evolving and changing, cryptocurrencies also have become more and more at the forefront of thought, and central banks now have to consider them as well. What is your take on digital currencies and a potential digital dollar down the road?
I think the digital dollar is quite a long ways off, but it really is very interesting to see countries like China doing very large-scale experiments with central bank digital currencies. And what's also somewhat ironic is that a lot of the impetus for the origins of Bitcoin and other digital currencies was a lack of faith in central banks. That after the global financial crisis, central banks were buying a lot of assets. We'd had this hyperinflation, and so we needed a private sector alternative to avoid debasement of the currency. Obviously, we've not had a lot of inflation. Maybe we will have that going forward. That's not my modal forecast, but it's possible. But it was the whole impetus was to decentralize and get away from central banks. But central bank can adopt the blockchain type of technology, and rather than have it distributed and decentralized, can totally centralize it. And that's obviously what China is going to do. And so there's going to be a real battle on the centralization versus decentralization of the technology.
Randy, are we going to see much more regulation actually on some of these cryptocurrencies, or is it just, has that boat now left?
So it's very, very interesting. When I was at the Fed through 2009, that's when Bitcoin had first started. And there's a debate in the Treasury, at the Fed and elsewhere about, what do these currencies mean? Are they just used by evildoers, bad guys, or can they be used for good purpose? And so I think that debate still rages. And so I think that the train has left the station, that we will have some forms of digital currency with us, whether they're primarily given by central banks or in the private sector. But I do think that undoubtedly with volatility and challenges in these markets, you're going to see some forms of regulation come in. And certainly some, like Coinbase, welcome that because they'd like to see more regularization of the market.
Randy, thanks so much. Randall Kroszner, the University of Chicago Booth School of Business professor and former Fed governor. What a great day to speak to you. Now, coming up in the next hour, Peter Hooper. He's Deutsche Bank Securities Global Head of Economic Research. Of course, we'll ask him about some of the new SEC rules that could affect U.S. stocks. We'll talk to him about inflation. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, we're also joined by Tom Keene, co-anchor of Bloomberg Surveillance, who's so excited about the inflation report coming up later that could actually move markets, and you have a great guest on it.
We got a really important guest on it. When David Folkert's landed on Jim Reed, Peter Hooper of Deutsche Bank. It's an early lead for the essay of the summer, Francine. It's on inflation, hugely controversial. It's made a very nice splash in New York. Dr. Hooper will join us here on their fears of the time bomb of inflation. They're not predicting that, but they're framing out how that could happen. That's a very strong day with us. Also looking forward to speaking to Jeff Yu, who will join us from BNY Mellon. The chart, Francine, is something to give you joy. It really is the ultimate Johnson victory chart. I'm going to call it the triumph of Boris. Trade-weighted sterling back 40 years or so, the John Major collapse, up we go with a miracle of Britain, and then down, 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 Brexit in the blue circle, and then we cratered. And would we do another John Major? And the answer is, ever so slightly, trade-weighted sterling is doing better.
Yeah, it is doing better. He's just distracted right now on his 100th fight with the EU over the Northern Irish Protocol. So it'll be interesting also how U.S. President Joe Biden actually navigates that, Tom.
Well, we're going to cover that. Of course, you know Guy is in Cornwall, as well as our Jennifer Jacobs. I just went back and forth with her. And Josh Wingrove will join us from the White House as well.
Yeah, Tom Keene, I'm looking forward to the program, co-anchor there of Bloomberg Surveillance, that will begin straight after Early Edition. Now, this is a look at what else we're watching. Kailey, CPI moving the markets.
Yep, just over 2.5 hours to go until that crucial consumer price inflation data, Francine. Of course, we're looking for a gain of about 0.5% on a month-on-month basis, which would bring the year-on-year gain to 4.7%. That's on the headline. For core, when you back out food and energy, looking again at 0.5% month-on-month. Of course, as we know, energy had a major impact in April's data as well. So that impact of higher commodity prices, definitely something to watch out for again, Matt.
You know, I'm looking on Google Maps for the original store number 1 at Brooks Brothers. Used to be on 44th and Madison Avenue. It was one of my favorite places to go. On the 5th floor, you could go up there, get a glass of bourbon, shoot some billiards with Tom the Tailor, but I don't know if it exists anymore. I'm not seeing it on Google Maps, and it's breaking my heart a little bit. You know, they've decided to move into athleisure, which I can't imagine saying Brooks Brothers and athleisure in the same sentence, but I guess we're going to have to do it now.
So, Matt, I know you're really upset about this. I find the story absolutely fascinating because it just, you know, I don't know whether it's athleisure all the way for everyone, but if you do formal wear, you have to do it right, and you have to make sure that you're making money at it. Otherwise, maybe you change tag.
Well, they invented, I mean, this is the American traditional suit maker. Now this is their new, Henry the Sheep is their new mascot. Previously, it was the Golden Fleece. I've got this tie as bespotted with
Matt,
Golden Fleece, albeit in red.
Maybe formal wear is more European vavavoom. I'm watching the ECB decision. It's at 7:45 a.m. New York time. Of course, the focus will be on what they do with the higher pace of emergency asset purchases, and it could move euro. Up next, more Bloomberg Surveillance. This is Bloomberg.